Good day. My name is Nina Saad, and I head up the area that manages the institutional multi-asset class portfolios here at Momentum Investments. I'd like to take this opportunity to give you a high-level overview of how our factor range of portfolios were positioned going into this COVID-19 environment and how we are navigating our portfolio management activities in these very challenging times. Since January, the COVID-19 outbreak has taken over our lives, presenting a challenge on multiple fronts, being medical, economic, and humanitarian. In what is certainly a historic period, the first quarter of 2020 saw a broad-based fall in markets. Global equity fell by some 25% in dollar terms. Our South African equity market fell by 27%, and listed property fell by a staggering 48%, leaving investors with very few places to hide, as even our defensive asset classes, both nominal and inflation-linked bonds, also posting negative returns to the tune of around 9%, and the only asset class that held up was cash. What we have experienced is unprecedented for all. It has not only been very sharp falls, but also the quickest fall in markets globally since the Great Depression of the 1930s. Diversification and risk management remain our best weapon in times like these, and our portfolios have for a long period of time had a healthy allocation to alternative asset classes, which has helped absorb some of the market shock. These alternatives include allocation to things like direct property, private equity, and real assets, which are less affected by the daily moves in markets and sentiment changes. At the back end of 2019 and leading into 2020, we started tilting our portfolios into quality counters by introducing a quality smart beta strategy within our equity portfolios. Going into the crisis, our portfolios were at their strategic mix between growth and defensive asset classes. However, within growth, we were underweight local property in favor of local equity, and within defensives, we were underweight inflation-linked bonds in favor of local cash. And where regulations allowed, we maintained our overweight exposure to globals, and this allowed the portfolios to benefit from rand weakness. This stood us in good stead as the crisis broke out. However, given the extreme market returns we have experienced, it has been almost impossible for anyone to achieve inflation targets, and the severity of the market movements have resulted in some portfolios experiencing negative returns, and the bulk of this decline concentrated in the month of March. Depending on the risk profile of a given portfolio and its accompanying asset class mix, the negative effect was dampened by as much as 2/3. So the more conservative portfolios provided members that are closer to retirement the level of protection that these portfolios are designed to do. In crisis times, market participants search for liquidity. All assets move pretty much in the same way, and asset class correlations converge to one. That is, they all start behaving in the same way, and diversification benefits are diluted somewhat in the shorter term. This has had a multiplier effect on South Africa, being one of the most liquid emerging markets. Our response here is to prudently protect asset values as we put hedges in place where it makes sense, and we gave our underlying investment managers more flexibility to take advantage of opportunities as and when they arise. Another phenomenon that is expected in times like these is volatility. In the last couple of weeks, now in April, there's been quite a rapid recovery in investment markets, with almost every asset class experiencing solid gains. And by staying the course, whilst managing the risks, our portfolios have participated in these upswings. We are ensuring that we have sufficient levels of protected exposure to growth in terms of equities and increased allocation to quality, and maintain an exposure to defensive asset classes. We continue to monitor these exposures and developments on a daily basis with a view to act swiftly and prudently to manage the optimal risk-adjusted outcome and maximize our probability of achieving our portfolio objectives. Until January this year, most of us had never heard of COVID-19, It has consumed our lives and transformed how we do things now and probably more permanently into the future. However, we want our clients to rest assured that as this situation evolves, our investment team continues to do what we have always done, and that is to remain anchored in our OBI philosophy and process, and we stand firm in the belief that to remain invested is the optimal long-term strategy while prudently managing the risks. Selling into market weakness locks in losses and also exposes investors to the risk of not climbing back into markets to catch the eventual rebound. In closing, I would like to leave you with a Charles Dickens quote. It was the best of times, it was the worst of times. I'd like to thank you for your time and look forward to catching up with you again soon.